interest rates, and the new farm debt trap. While products multiplied, one quiet variable reset the math: the price of money. In the low-rate era of the 2010s and early 2020s, farmland felt like a cheat code. You could borrow cheaply against stable collateral, lock in spreads with rent, and let appreciation do the heavy lifting. Debt service barely nibbled at cash flow, and appraisals kept stepping higher, making yesterday's leverage look conservative. That comfort disguised how sensitive the whole stack was to the cost of credit. When rates rose, the first pinch surfaced in margins. Funds rolling short-term debt faced higher coupons. Lines priced off benchmarks reset upward, slicing into dividend coverage. On the ground, that pressure translated straight into the lease. Rent escalators that once felt academic became non-negotiable. Renewal offers came shorter, 1 to 2 years, with higher base rents and CPI adders to protect the model. If a tenant balked, the asset manager called it re-tenanting risk and chased a larger operator who'd accept tighter terms. The balance sheet got relief. The farm's cushion disappeared. Meanwhile, bank lines were built on inflated comps. During the boom, appraisals leaned on sales set by funds bidding with cheap debt. Those prints fed loan-to-value ratios, which fed credit capacity. When rates jumped, those same lenders started stress-testing cash flows against higher debt service. Coverage ratios thinned. Covenants whispered. Advance rates ticked down. Suddenly, land that always comped had to stand on income, not stories. That's where the appraisal contagion began. One lower sale to meet redemptions or debt payoff reset the marker for a whole county. Debt layering made it worse. Farms weren't just collateral for farm operations, they were collateral for everything built on top of them. A fund might secure a revolver against its farmland portfolio, then pledge portions to back mezzanine financing for an acquisition, then carve out a solar option for extra income to cover the blended cost. Each layer assumed liquidity on demand. When borrowing costs rose and exits slowed, those layers tightened like a tourniquet. To free the limb, managers sold parcels fast. Fire sale discounts printed. Local lenders watching those prints adjusted underwriting. Neighbors saw their equity shrink on paper without a single furrow touched. That's the echo of the 1980s farm crisis, playing in a financialized key. Back then, rate hikes crashed land values and wiped out thousands. Today, the mechanics rhyme, but the holders are broader. It isn't just local banks and families, it's pensions, REITs, insurers, and sovereign funds. When they face pressure, they don't call the seed rep, they call the redemption desk. Meeting withdrawals forces sales, even in regions mid-harvest. The selling doesn't ask if a drought just knocked yield or if a water district cut allocations. It hits market and moves the number. Here's how the trap closes on an operator. A tenant signs a 3-year lease in 2021 at a rent that penciled with sub 3% money and moderate input costs. Fertilizer spikes, diesel climbs, rates jump. The fund's debt service bites, and the lease has a CPI kicker. Year 2 rent rises while net price for the crop slips. The farmer asks for relief or a longer term to invest in efficiency. The answer is a shorter renewal at a higher base or a notice to vacate. The farmer leans on a local lender to bridge the gap. That lender is marking down collateral after a nearby sale cleared 12% below last appraisal. The line doesn't stretch. The farmer trims inputs, chases yield, and hopes for rain. One weather miss, and the lease churns. The land doesn't change hands in a deed room. It churns in a spreadsheet. Rate hikes also rerouted capital flows across the portfolio. Money that once chased farmland on the promise of smooth, bond-like returns found actual bonds paying more with less hassle as rates climbed. Open-ended vehicles felt it first. When inflows cooled and some investors asked for cash back, managers raised gates or sold properties. Both options radiated stress. Gating told the market liquidity wasn't what the brochure implied. Selling at a discount established new comps. Either way, the cost of capital got heavier for the next buyer, and rent needed to rise again to make the pro forma hold. Meanwhile, insurers and pensions that had framed farmland as duration hedges found duration risk hiding in the leases. Rising rates cut the present value of appraised income streams just as rent affordability hit a ceiling. The lever left was term, shorten leases so they can be repriced faster. But shorter terms kill long horizon practices that protect yield. Rotation, cover cropping, precision water investments. The soil becomes a quarterly surface, not a generational asset. That trade shows up later in volatility. Fields get riskier as financing demands more stability. Appraisal contagion spread through credit committees. Regional lenders who once leaned on a stack of strong comps saw the top comp turn stale and the freshest one arrive with a distressed footnote. Seller motivated due to fund restructuring. Committees shaved loan-to-value by 5 points and raised rates by 150 basis points. That seeped into operator lines, input financing, and equipment loans. Every notch up in cost tightened decisions. Which acres to plant, which inputs to skip, which field to leave fallow. The aggregate impact wasn't just financial pain. It was production choices made under credit constraints, not agronomy. So who kept belief alive? The same voices that framed land as an inflation hedge rewrote the sermon. Higher rates create disciplined buyers. Long-term scarcity still wins. Conferences and decks refreshed the story with new phrases. Resilient cash yield, drought-adjusted underwriting, water-smart alpha. The narrative reassured the allocators whose capital set the bid. But out past the slides, the rate regime had already changed the rhythm. Money moved slower, leases moved faster, and the gap between a farm's income and its imagined value narrowed the hard way. The trap isn't complicated. Cheap money let financial owners stack leverage on land that produced steady, seasonal income. Expensive money forces that stack to shrink. Shrinking stacks don't absorb risk. They export it, to tenants, to local lenders, to grocery aisles months later. And while sermons steady hands for a quarter, the collection plate is passed downstream. Selling scarcity, conferences, decks, and AG Alpha. While rates were tightening the screws in the fields, the story stayed glossy in ballrooms cooled to 68 degrees. At farmland investment summits, the first slide is always a sunlit field. Then come the curves, returns since 1992, volatility bars half the size of equities, a tidy line beating inflation. The voiceover swaps agronomy for finance, uncorrelated, durable, essential. Scarcity becomes the headline. They're not making more land, a presenter says, and 100 pens move at once. Get this, the pitch never mentions mud. It speaks in abstractions, acreage units, sub-basin risk, drought-adjusted models. An orchard becomes a yield vector. A county becomes a basis point. Agricultural alpha is the phrase that sticks. It promises something more than beta on a scarce resource, something earned through manager skill, better tenants, smarter water, proprietary data. Soil-based stability follows as the anchor. The earth itself is framed as a balance sheet that composes itself slowly, predictably, safely. ESG language wraps the structure. Decks cite sustainable practices, carbon potential, habitat corridors. A bullet point flashes, regenerative pilots on select tracts. But read the footnotes. Pilots don't change fee math. Management fees still accrue on assets gathered. Performance fees still clip appreciation. Sustainability lives in the paragraphs. Finance lives in the terms. The structure doesn't bend for cover crops if a one-year lease with a CPI ratchet prices cleaner. Data helps tell the story. Advisors cherry-pick windows when farmland stair-stepped up while stocks whipsawed. The chart looks calm because appraisals lag. That lag is sold as low volatility. In Q&A, someone asks about profit per acre. The answer switches to rents and cap rates. Income on the farm is inconvenient. Income to the fund is the product. If per acre profits flatten while valuations rise, the deck reframes it as capital deepening and portfolio optimization. Managers lean on comparisons. Soil values next to gold reserves. Acres mapped like pipelines. A speaker draws a line between grain demand and demographic trends. 9 billion people need to eat. Therefore, the land that feeds them earns a premium forever. It's tidy. It leaves out the hard edges. Aquifer caps, salinity creep, input cost shocks. We underwrite water, the slide says. The line you don't see is the one on a farmer's renewal, shorter term, higher base, KPIs that move faster than rain. The moral hazard sits off stage. Fees are earned whether the tenant thrives or churns. A manager says, we focus on tenant quality, meaning operators who can absorb rent hikes and carry inventory. Smaller families, the ones who invest sweat in soil over decades, don't fit the debt profile. Retenanting a tract and marking rent up 5% counts as value creation. Soil organic matter doesn't make the quarterly email. Conferences are where faith gets written. Allocators need a narrative that justifies an entry point, a pacing schedule, and a number for their board. Scarcity, stability, and story do that work. A CIO hears bond-like with upside and slots farmland between core real estate and infrastructure. The line item's job is to be quiet. The irony is that the quiet depends on loud pressure outside the slide deck, rent escalators, term compression, and covenants that visit the farm gate as emails, not neighbors. Here's where it gets practical. Decks include case studies. WaterSmart Alpha lifted NOI by installing drip systems and repositioning tenants. Translation: capitalized a basic irrigation upgrade and swapped a tenant who asked for a longer lease for one who didn't. Another slide touts resilience through optionality. Solar overlays, agrivoltaics, logistics adjacency. That optionality reads as diversification. On the ground, it nudges land away from crops when margins tighten, reducing local supply and pushing volatility into prices. Data cherry picking shows up in regional maps. Midwest core yields a steady rent roll, while specialty crops enhance return profile. Specialty crops also amplify risk: water, frost, pests, yet the composite chart smooths it. The smoothing happens because appraisal marks don't swing like a futures screen. In lean years, funds sell attract quietly, keep the dividend steady, and move on. The story holds in the room because the room isn't priced by drought. ESG spin isn't all smoke. Some funds do push better practices, but incentives still point to AUM. A manager who turns down a hot county with stressed water because the aquifer is wobbling earns no fee for prudence. A manager who wins the tract at a thin cap rate and raises rent to fit the pro forma earns both fees and praise for conviction. The discipline that matters for soil runs on decades. The discipline that matters for decks runs on quarters. AG Alpha gets the last word because it flatters both sides. The manager is a steward, not a speculator. The allocator is solving for planet and pension. The farmer is a KPI. That's the fracture. When the sermon ends and the capital flows, the terms must land somewhere. They land on shorter leases, higher rent, and rigid benchmarks that tighten when weather or trade moves the wrong way. Those pressures don't show on a slide, but they ring at checkout later. The scarcity story sells because it's partly true. Land is finite. Water is finite. Food demand is inelastic. But scarcity priced as certainty turns fragility into a yield strategy. Conferences keep the music playing. Decks keep the steps memorized. AG Alpha keeps the hope alive that this time, finance can smooth seasons. Out in the fields, seasons still call the tune. And the next verse is already loading into models. On the ground, how financialization warps farming. Walk the rows, and the terms show up like footprints. Shorter leases first. A 1 year with a ratchet. Maybe 2 if the rent escalator bites a little harder. That horizon changes everything. On a 12-month clock, you don't plant windbreaks, you don't rebuild terraces, and you definitely don't sink money into slow payback practices like cover crops or deep-rooted perennials. The soil becomes a temporary surface to be pushed for yield right now, because next year the rent resets and the tenant might not be you. Rent escalation does the rest. When valuations sprint ahead of farm income, the spreadsheet solves by hiking rent. Operators try to pencil it. The math forces a pivot toward high input, high output bets. More nitrogen to chase bushels. More irrigation to secure weight. More aggressive planting windows to squeeze a second crop. The spread between the cost of inputs and the expected price of the crop narrows, but the lease just wants the check. If the season cooperates, you survive. If it doesn't, the clause enforces. Algorithmic enforcement is the new neighbor. Leases now carry performance KPIs that report into dashboards, yield targets, moisture thresholds, delivery timelines. Miss 2 benchmarks and a warning pings. Miss a payment date, and the system generates a termination notice before the farm office opens. There isn't a conversation under a shade tree about why the canal ran short in July. There's a PDF with a box to tick if you want your security deposit reviewed. Efficiency replaces empathy because efficiency meets the quarter. So cropping choices start coming from spreadsheets. A fund underwrites a tract assuming a certain water profile. The model pushes growers toward varieties that hit those modeled yields. That can mean almonds over alfalfa in a stressed basin, or continuous corn instead of a soil-resting rotation, because the cash rent assumes year-round productivity. Water risk moves to the aquifer. Fertility risk moves to the topsoil. The balance sheet stays smooth until it doesn't. Here's a human vignette. A dryland wheat family in western Kansas hits a 2-year drought cluster. They've farmed that section for 3 decades on handshake renewals that turned into PDFs. The new owner is a fund that added CPI kickers. Harvest misses by 20%. The family asks for a 1-year rent freeze and a 3-year term to justify a no-till drill and stubble management that would help the soil recover. The asset manager sends a polite refusal. Our policy doesn't accommodate below-market rents. 30 days later, the lease is offered to a larger operator who promises to meet the KPI by adding a chem-fallow regime and pushing acreage harder in wet years. The fund logs tenant upgrade. The family loads a second semi with equipment they hoped their kids would run. That churn has a cost you won't see on a deck. Shorter tenures erode local knowledge. Where the low spot floods first, which wind breaks protect tasseling corn, the specific field that needs a slower planter because of a soil seam. Those details live in a person over time. Lease churn bleaches them out. Mistakes get made, corrected, and made again because the operator changes before the learning sticks. The squeeze extends to rotations. A 5-year plan that includes a cover crop year and a lower revenue legume can build fertility and suppress pests. But a 1-year lease with a rent ratchet demands the highest revenue option every season. That often means monocropping and heavier chemical dependence. The soil takes the hit in structure and biology. Yields can hold for a while with more inputs. Then a dry spring or a pest bloom cuts through the veneer, and the operator is left with both a weak field and a strong rent bill. Processing contracts feel the pressure too. Financial owners push for fixed delivery windows and volumes to match their cash flow needs. That rigidity trickles down into crop calendars. A processor wants uniform tomatoes every week in August, so growers plant to hit that window even if weather suggests shifting. If fields miss, liquidated damages clauses trigger. The farmer absorbs penalties. The fund still files a rent check. A quiet shift shows up in insurance. Some owners embed captive insurance into leases, mandatory products that cover certain risks, but exclude the ones the farm is actually facing. The premium becomes another fee stream upstream. The operator pays for a safety net with holes in the places the weather now tears. Technology arrives with strings. Remote sensing and moisture probes are useful, but when they're tied to lease KPIs, data turns into discipline. A dashboard flags evapotranspiration outside a band, and a notice goes out. The farmer explains a gust front and a sandblasted edge. The system registers noncompliance because the band is the band. That rigidity pushes behaviors that meet the metric, not the conditions. Extra irrigation to hit a moisture target even when a cool front is 24 hours out. Water use climbs to satisfy a spreadsheet. The bigger operators thrive for a while. They can absorb rent hikes, negotiate volume discounts on inputs, and spread compliance staff across counties. Scale buys time. It also compresses diversity. A region shifts toward fewer crops under fewer companies, all walking the same tight lease line. When a shock hits, hail, a trade hiccup, a water cut, the impact multiplies because everyone made the same bet under the same terms. Meanwhile, the social fabric thins. Local equipment dealers lose service contracts when families exit. Co-ops shrink. School rolls fall. County tax bases wobble when valuations stall or sales clear below appraisal. The financial owners don't attend the budget meeting when the school asks why the bus route is shorter. They file an NOI update. None of this is inevitable. It's mechanical. Short terms push short-term decisions. Rent escalators push input intensity. Dashboards push rigidity. Each step is rational on a balance sheet and costly in a field. And those costs don't stay put. They walk off the farm in the form of tighter supply, more fragile output, and prices that carry a volatility premium you meet at the register. From field to aisle, how the bubble hits your grocery bill. Here's where the contracts turn into prices you can feel. Start with cost pass-through. When land valuations run ahead of farm income, rents chase appraisals, and operators have 2 levers: push for higher yields or push costs forward. Inputs rarely get cheaper on command. So the rent and financing burden get built into the price floor farmers require from processors, packers, and buyers. Some seasons, futures markets don't cooperate. The gap shows up as tighter supply, thinner bids, and a quiet tax called volatility that retailers price in before you walk through the door. Finance-driven consolidation amplifies every shock. When a region tilts toward a few large operators under similar lease terms, their decisions sink. A heat dome hits, water allocations dip, and the same rent escalators push the same crop choices at the same time. Instead of a patchwork response, you get a chorus. Processing plants see uniform shortfalls, spot markets tighten. And because ownership is concentrated, a fund navigating debt coverage across multiple counties makes portfolio decisions that ripple through entire supply lanes. Pause replanting here, accelerate sales there, hold inventory if a bond covenant is close. Those choices aren't about food, they're about financial timing, and the aisle feels the timing lag. Contract rigidity turns agronomy into a metronome. Processors and retailers favor fixed volumes and schedule certainty, so upstream contracts lock in delivery windows and specs. Leases then mirror those demands with KPIs and penalties. In a normal year, the machine hums. In a weird year, the kind climate makes more common. Those fixed promises force bad fits. A grower can't pivot out of a failing crop without breaching terms, so they double down and miss anyway. The penalty lands. The next negotiation resets price expectations higher to cover future risk. The premium for predictability becomes part of the sticker. Then there's the multi-asset pivot. Financial owners prize optionality. If a crop cycle underperforms and power prices rise, a solar lease on marginal acres may beat soy. If a highway expansion creeps closer, a logistics pad outruns wheat. On a spreadsheet, this is portfolio optimization. On the ground, it's fewer planted acres exactly when weather or trade squeezes supply. The local cannery faces a shortfall and pays up to secure throughput. That higher procurement cost filters into wholesale pricing and rides with the pallet into your store. Retailers don't wait to be surprised. They hedge risk. When upstream looks jumpy, rents ratcheting, leases shortening, redemptions whispering, procurement teams build buffers. They expand contracts across geographies, add premiums for priority loads, and hold extra inventory where cold chains allow. Insurance gets layered too, from cargo to business interruption. Each layer has a price. The grocery aisle becomes a place where you pay not only for tomatoes, but for the right to not see an empty shelf during a bad month. Call it a stability surcharge. You won't find it on a sign, but you'll feel it across categories. A microstory ties it together. A Midwestern cannery sources sweet corn from a belt of farms, many now owned by funds that tightened leases after rates rose. A June storm shreds stands.